UK share schemes and tax implications. If an employee is given shares outside of a formal share scheme, and these shares are classified as a readily convertible asset, i.e., they can be sold on a stock exchange or have a similar market, the value of the shares is treated as earnings. This means it is subject to income tax and Class 1 national insurance contributions. Share schemes are arrangements through which employers offer employees rights to acquire company shares. These schemes are scrutinized in tax assessments and have distinct tax implications. This video provides an overview of different share schemes, their characteristics, and their tax consequences. Definitions. Grant. The date when an employee is granted the right to purchase shares at a future date at a price determined at the time of the grant. Exercise. The date when an employee decides to utilize the right to purchase the shares. Disposal. The date when an employee sells the shares they own. Tax-advantaged schemes. There are 4 types of tax-advantaged schemes that must meet specific conditions. Share Incentive Plan. Share incentive plans, approved by HMRC, offer significant tax advantages. Offering shares. Employers can provide shares to employees at a discount or for free. Typically, this would be treated as a benefit in kind, with the employee liable for income tax and the employer for Class 1A NICs. However, under an approved share incentive plan, different rules apply. Tax treatment. At grant, no income tax or NICs are due. At disposal, the tax treatment depends on how long the shares have been held. Capital gains tax, CGT. No CGT is payable. The market value at disposal is used as the deemed cost, resulting in zero gain. Conditions. The plan must be available to all employees who have worked for at least 18 months. The maximum value of shares is £3,600 per year per employee. Shares must be held for at least 5 years for full tax advantages to apply. Additional notes. If the shares are sold before 3 years, NICs are based on market value at disposal, payable in the tax year of disposal. If held for 3 to 5 years, some benefit applies, taxed on the lower of market value when received or at disposal. If held for 5 or more years, no income tax or NICs apply. Free and matching shares may be forfeited if an employee leaves within 3 years, unless for specific reasons such as retirement or redundancy. Structure and operation. Employers establish a trust through which employees are given shares rather than options. The plan must be open to all full-time and part-time employees, with a possible minimum employment period of up to 18 months. The terms must be consistent for all employees, based on objective criteria like length of service or hours worked. The plan cannot favor directors or highly paid employees. Employees can deduct up to 10% of their salary or £1,800, whichever is lower, from pre-tax pay to buy partnership shares in a tax year. Employers can match up to a 2-to-1 ratio on partnership shares. Stamp duty is not payable by employees when purchasing shares from the SIP trust. The trust pays when it acquires the shares, and this is not considered a taxable benefit. Qualifying conditions. Shares must be fully paid, irredeemable ordinary shares. They must be in the company or its subsidiary, and the company must not be controlled by another company. A group plan can be established by a company that controls other companies. Trust and plan components. The plan must be operated through a UK resident trust. Trustees acquire shares from the company or from employees if they are partnership shares. Shares are not readily convertible to cash, so no employer NICs are required. The plan can include different components, such as free shares, up to £3,600 per year per employee, partnership shares, employees can purchase up to £1,800 or 10% of salary per tax year. Matching shares, employers can award free shares to match purchased partnership shares, up to a 2-to-1 ratio, and dividend shares. Dividends on shares in the plan are tax-free if used to acquire additional shares and held for 3 years. Share option schemes. Share option schemes allow employees to buy shares in the future at a predetermined exercise price. The typical tax position is as follows. At grant, no income tax or NICs. At exercise, generally, no income tax or NICs are due unless the exercise price is lower than the market value at the time of grant. In such cases, the difference is subject to income tax at exercise. Capital gains tax, CGT. The deemed cost is the exercise price. Any income tax paid on the difference between market value and exercise price can be added to the base cost of shares. Additional notes. This applies to employees in a trading company. If an employee holds 5% of shares, it may be considered a personal company, and the Business Asset Disposal Relief, previously known as Entrepreneurs Relief, may apply, offering a 10% CGT rate. For Enterprise Management Incentives, EMI, there is automatic qualification for Business Asset Disposal Relief, even if the employee holds less than 5% of shares. Save as you earn, SAY, share option schemes. This scheme allows employees to make regular monthly investments, £5 to £500, in special ShareSave accounts for 3 or 5 years. The exercise price must be at least 80% of the market value at the time of grant. The scheme must be open to all employees, full-time and part-time, and full-time directors, though part-time directors may be excluded. Employers can add a tax-free bonus as interest. A minimum qualifying period of employment, up to 5 years, may be imposed. At the withdrawal date, employees can either take cash or use the money to buy ordinary shares in the employer under options granted when they started saving. Company Share Option Plan, CSOP. The maximum unexercised options per employee is £30,000, valued at the grant date. Employees must have owned 30% or less of shares in the preceding 12 months. Options must be exercised between 3 and 10 years after the grant. The company can be selective about which employees or full-time directors participate. Employees holding over 30% of a close company in the preceding 12 months or who control the company either alone or as part of a consortium are excluded. Shares must be fully paid ordinary shares, and options must not be transferable. If the company has more than one class of shares, the majority of shares in the scheme must not be held by directors and employees unless it's an employee-controlled company or a holding company, unless shares are quoted. The tax exemption is lost if options are exercised earlier than 3 years or later than 10 years after the grant, except in certain circumstances such as cessation of employment due to injury, disability, redundancy or retirement, or a cash takeover of the company or a forced exercise of options. Enterprise Management Incentives, EMI. The maximum value of options per employee is £250,000, valued at the grant date, with a total of £3 million for the company. The CSOP reduces the £250,000 limit, but SAY does not affect it. Employees must own 30% or less of shares. Options must be exercised within 10 years after the grant. If the £250,000 limit is reached, no more EMI options can be granted for 3 years. This scheme is intended to help smaller, higher-risk companies recruit and retain employees. Company eligibility. The company can be listed, but gross assets must be less than £30 million. It must have fewer than 250 full-time equivalent employees at the time the options are granted. It must not be under the control of another company and must carry on one of the qualifying trades. The company must have a permanent establishment in the UK. Employee eligibility. Employees must be employed for at least 25 hours a week, or if less, at least 75% of their working time, including self-employment. Restrictions. Restrictions on sale, forfeiture, and performance conditions can be set. Shares must be fully paid up, irredeemable ordinary shares. Tax treatment at exercise. An income tax charge, and possibly NICs, is applied at the lower of the discount between market value at grant and exercise price, or the difference between market value at exercise and the exercise price paid. Disqualifying events. Disqualifying events, such as an employee ceasing to spend at least 75% of their working time with the company, may trigger a tax charge unless options are exercised within 90 days of the event. These share schemes offer various tax advantages and are designed to incentivize employee ownership and retention. The choice of scheme depends on the company's size, structure, and objectives, as well as the desired tax treatment for both the employer and employees.